Hello and welcome to the Bucks Creypto Club weekly catch-up over virtual coffee. It's Sunday, 17th of May 2020, and we're just going to be chatting about what's going on in the world of crypto. It's now several days after the Bitcoin halving happened. The price of Bitcoin has been going up, it's going down, it's been going up again. Ethereum seems to be tracking quite similarly, so we'll see what views people have got and what's going on in this crazy world.
Go.
How's it going, Anthony?
Yeah, not too bad, mate.
Yeah.
Well, something new for this week. I got some merch.
Oh, a t-shirt.
I got my t-shirts. Yeah.
Very good.
So yeah.
I usually have my cup of coffee with my Distalytics logo on it, but unfortunately, one of the mugs broke the other day and the handle came off. So.
Yeah. This is my normal mug that I got on. Well, actually, on our honeymoon when we went to South Africa, we went along the coast. So I picked it up, but it's got a lovely crack in it, which I can see inside it, and it's got the crack kind of more or less goes through. So I don't know how long this is going to last. So
Okay.
Sarah's got me a Bitcoin mug.
I've got a brilliant one which I should actually use for these sessions, which one of my friends and neighbours bought me, which says blockchain miner on it, which is rather good. And he said he saw it somewhere in the middle of nowhere. He said, and I thought of you, and I just had to get it. So it's really good, and it's a great mug. It's worked really well. Whereas I tend to have this one at the moment, which I don't know if you can see that with the virtual screen.
Yeah.
It was bought.
Oh, yeah, Wasp.
Yeah, so it was bought at the London Wasps shop in High Wycombe just before Wasps moved out of High Wycombe. They moved to Coventry, I think. So they had a closing down sale. So it meant they had loads of mugs going cheap, which was great.
Oh, cool.
So that was pretty good. So you've been watching what's been going on in the crypto world this week?
Yes, I have. Yeah, especially the halvening that kind of happened. What was it? Kind of Monday going into Tuesday. Is it Tuesday morning? Wow. I actually ended up watching a lot of Tone Vase on YouTube. He did a 12-hour marathon, but he had such interesting guests on. And I sometimes don't like listening to it when I'm out kind of walking or kind of just doing kind of general tasks. So I was listening to it at like 2 times speed, but some of those guests were really, really insightful about what is kind of happening, not just with the halvening, but with the economy at large. And we saw the dump. We actually saw that the price did take a bit of a fall, seems to have stabilized at the moment. But I am wondering whether, with the larger economy not factoring in through stocks and bonds, this coronavirus, we're going to have another massive downturn with stocks, and would that impact Bitcoin? The longer it takes for that downturn to come in the stock market, it gives Bitcoin a bit more of a time to increase in price because there's much more demand coming in. But yeah, it's a case of, is the stock market going to be correlated to Bitcoin when there is a huge dump, or has it started to become not correlated to the stock market? We've seen signs of that this week, which is great. But will it continue to go up if we see the stocks going down? That is a question, and I think everyone just should be wary of that.
Yeah, and it's something, again, on a couple of the Facebook forums that I'm a member of, I think a couple of people have been saying, oh, great, this shows that the halvening, you saw a 5% increase the other day in the Bitcoin price, and, oh, yeah, well, we predicted that, and blah, 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 blah. To which my response was, well, did you predict the 20% drop 2 weeks earlier? It's like, oh, well, maybe. So I still think a lot of this is just either pure play speculation and randomness interspersed with people manipulating the markets. And it's the old, what was the Sage of Omaha?
Warren Buffett.
Warren Buffett, his comments about the stock market is about transferring the wealth from the poor to the rich or something, or that transferring wealth from the foolish to the prudent, or something like that. In some ways, I think crypto's replaying that there are a few people who are doing very, very well by knowing how to manipulate the market, and they're taking the money off people who think they are experts in anticipating the market. So yeah, it's all interesting stuff.
I think that happens in the traditional side as well, though, doesn't it, Gary? But yeah, definitely maybe exacerbated in the crypto market. There's so many different signals. And I don't think it's easy to predict. First you've got all the traders with their lines and their kind of fake outs and breakouts and dead cat bounces. Yeah, that's fine. But if you have a crash in the stock market or a global pandemic, that affects it. You've got the China, if they bring in any kind of legislation or something, that affects it. We've even got a new Ponzi scheme going in China. So we had the kind of, is it one world or something?
Oh yeah, one coin.
Yep. Yeah, and now there's another one that's taken about $1 billion worth of crypto. It's throughout China, and so they've got something like 40,000 bitcoins or something they managed to amass. So if they dump all of that on the market at the same time, that is going to crash the price. Yep. So you have all of these different factors, and I'm not too sure you can easily make a judgment call. I think it needs to go back to fundamentals. What is the current economy doing, and what are the fundamentals of Bitcoin and other cryptocurrencies doing? So I'm always kind of like a fundamental macro environmental trader rather than timing it, dollar cost averaging over time.
So it's kind of interesting you mentioned that, because I've got a fundamental belief about fundamentals, that fundamentals don't work for cryptocurrencies because there are no fundamentals. Fundamental in the stock market sense is basically if a company was to close tomorrow and you sold off all of its assets and you netted out its liabilities, how much money would be left? And if you divide that by the shareholders, then that's what the fundamental value is. With crypto, I keep having this discussion with crypto advocates all the time. If you had, say, Bitcoin SV or Litecoin, or choose a coin of your choice, you had some holdings in that, and that network closed down tomorrow, then how much would that crypto be worth? Now, doing fundamental analysis, you'd say, well, you'd sell the servers off and all that kind of thing. But in crypto, as you know, you don't get to benefit from that. So my argument is still that fundamental value of any crypto is zero. And I keep having battles with people with that. Technical analysis definitely works, simply because enough other people are using it. But I agree that it's interesting to see what fundamental things are happening in the world. So we've got things like the virus, oil price collapse, stock market collapse, economic. We're heading, if we're not already in a recession, we soon will be. Probably the greatest depression for a long, long time. How does that correlate in crypto? Because at the moment, I'm still not seeing any correlation between fiat currencies, gold, property, and crypto. There's just not that major correlation there. We'll see.
Oh, there is one.
Yeah.
Okay, so you mentioned a couple of things there. First, the fundamental side about kind of understanding the assets for a company. Let's take, for instance, Carnival Cruises. Mm-hmm. Stock price has plummeted. The amount they have in assets, i.e. their ships, are actually worth more than their market cap. And so there is a fundamental price discrepancy there. But even if you kind of boil it down to how much the company is worth with all of their assets, you've then got to think about the macroeconomic environment and go, well, how many people are going to go on cruises? Mm-hmm. So, whilst there is a fundamental price for the company, you've got to also look at the environment that it's in.
Sure, but with Carnival, that their bookings are up 600% at the moment.
No, I didn't know that.
Which
that's an interesting stat.
I found bizarre. So someone shared that the other day, that their bookings right now have rocketed, which again is exactly the opposite of what you expect. And going back to your point about, that the ships are worth less than their book value or whatever. Well, actually, no. The ships are
No, no,
worth what?
ships are worth more.
But they're not. But they're not.
The price of a ship, actually, all of their assets together are worth more than their total market cap from their stock.
But
So,
this is the thing, that it could well be. It's either that the share price is mispriced at the moment, which is quite possible, or it could be someone's done a revaluation based on how much the ships have got a book price and they've got a market price, and the price of a ship right now, unless it's an oil tanker, has probably collapsed, and so you may not have quite that gap
yes,
after
you've
all.
got to factor that in as well.
Yep.
And then going back to your, I want to have a robust discussion about cryptocurrencies going to zero. Yeah, that's so you're on the side of they will go to zero if you turn off the network. Well, we've already seen.
I'm a believer that they can go to zero, not necessarily. I'm not a doom monger that they will.
Okay, because we saw IOTA, didn't we, turn off their network for a whole month, and yet their price didn't collapse. But it went down a little, but it didn't collapse, and actually kind of rebounded, which is surprising to me. But also from the point of these cryptocurrencies, if they're decentralized enough, then they won't go to zero, because someone's always going to be able to trade them. Even if the price is 10 cents. So things like Bitcoin and Ethereum would never, ever go to zero, because it's decentralized enough that the network could still be there. And people can still trade on it on the platforms that we have. So it would never go to zero, but the other centralized platforms definitely would.
Yeah, and that's something maybe, I mean, you're absolutely right. Providing you've got liquidity and providing you've got enough buyers and sellers to keep a marketplace going, then it will be more than zero. But you only have to take a look at, there are over 5,000 cryptocurrencies now, of which I don't know what percentage are tokens, but it's probably a fairly high percentage. Most of them are almost as good as being at zero. I've been tracking one crypto project recently, which did an ICO in 2017, and I've been watching their price gradually whittle away and whittle away. And it's kind of interesting
but they're on the Ethereum network, and the Ethereum network won't go to zero because it's decentralized enough.
So maybe
there will always be a place, maybe like even Uniswap, decentralized marketplaces where you can swap these ICO tokens because it's on Ethereum.
But that might be the thing, that it might be that Ethereum will maintain a value because it is providing a platform that others are building stuff on. Definitely. Whereas interestingly enough, Bitcoin doesn't. So that is a difference between the two of them. But the tokens may well go to zero. Most of them probably will, and I expect a lot of the cryptocurrencies will as well. But yeah, all I know is I think we all get it consistently wrong.
Yeah. And sometimes you actually see some. I mean, there's been plenty of cryptocurrencies that have come and gone, but you don't see them going to zero. You just see them kind of bottom out, and the liquidity is just so low that you will never be able to sell them. But because the liquidity isn't there, but the price is still there. So,
but that's cool. The thing. That,
and then you mentioned,
if you can't sell it, then it's as good as zero, isn't it? It's a bit like I had a car years ago that was worth so little it was going to cost me money to have it towed away, and yet it still had. Funnily enough, this goes back to fundamental analysis, that if you'd have taken it to a scrapyard and taken the starter motor out and the gearbox out and whatever, it probably had an underlying value, but the cost of recovering that value was greater than what I could get, which is why I gave it away.
Yeah, exactly. And then you mentioned a model that plots kind of Bitcoin against other assets. Plan B has come out with a stock to flow model and has actually successfully now modeled Bitcoin against other commodities like gold and silver. And so he's using the same measures. So the stock to flow ratio is that if you were to get rid of all of the supply, how long would it take you to stock back up to the levels that you were at?
Mm-hmm.
So what is the flow rate coming in? So if you got rid of all of gold, what is the flow of gold into the market? And that gives you a number. Was it I'm trying to it gives you, if it's a very, very low number, a stock to flow, it means that it should be priced high. And yeah, but check out Plan B stock to flow model. He has actually done it, and he's been on a few podcasts as well talking about it. And it's the best model we have for how Bitcoin is going to react, especially compared with other commodities.
But again, that's a supply side based calculation, isn't it? And not a demand one. And it assumes that there will be demand. And this has been my criticism of people talking about the halving will guarantee a price increase because it halves the supply. And I said, well, yeah, but that only works if the rate of demand remains the same in some way. And I guess with an STF model, that's similar.
Yes, I guess you can, yeah, bring in the demand side. But then you've got to kind of think that Bitcoin, even if there is twice the demand, that does not affect the supply.
Mm-hmm.
Yeah, so it's the only asset out there where the demand does not affect the supply. If gold was to have huge demand, there would be more companies getting into buying gold refineries and digging it out of the ground. And so the demand in gold affects the supply, but not in Bitcoin.
Actually, I don't think that's true. And I think that it may well be that gold mining operates in a similar way to diamond mining, whereby there are a small number of operators in that space who dominate the market. So diamonds, for example, the comments I've had from people in the market is that absolutely there's a massive potential supply of diamonds. It's just that the likes of De Beers only release them at a particular rate each year to maintain the price. And so if there was a sudden massive spike in the demand for diamonds, say they suddenly discover there's a new industrial need for them in some way or whatever, then the extraction of diamonds would not change. They would hold it the same because they'd then be benefiting for a higher profitability on a smaller number of units.
Bit like oil then.
Yeah, and in fact, that's really funny when you look at oil. What's happened with that when demand collapses, they're still pulling it out the ground because whether they want it or not, type thing. It's actually more expensive with oil to stop your extraction and refining process than it is to give it away.
Well, I think it's the same for a lot of these refineries and large kind of downstream, manufacturers and refineries. They can't just easily turn it off and turn it on, maybe like you could, a Bitcoin mining farm.
Yep, and that might be the thing, that with crypto, you can rapidly respond to marketplace changes, with the proviso that, as we both know, one of the major drivers of the Bitcoin protocol is that supply, the rate of supply is fixed.
No, definitely. And that's why I think, if you get demand in oil or gold, you will have companies adjust and build facilities to capture that demand. In Bitcoin, because it's a supply demand curve, more demand means price go up.
Mm-hmm. Providing there's more demand. And by that same principle, and I get that because it's kind of economics 101, then what happens if demand goes down? Then that equally reduces the price, doesn't it?
Yes.
So subject
Exactly.
to
But
elasticity.
if we now kind of wrap it all up in a nice circle, looking at the fundamentals and the macroeconomic environment, everything is pointing towards Bitcoin being a bit of a savior in this, where you can't control the asset and you can't inflate the asset, and it's so the macroeconomic kind of fundamentals come into this as well.
Yeah. So whilst this isn't financial advice,
No, definitely
Yeah,
not take my
yeah,
financial advice, but
yeah.
I'm just a guy on his podcast.
Yeah, this recording is purely for educational and learning value and is not to be treated as financial advice or
Indeed.
taxation or legal
I am not a
advice.
financial advisor. I'm just a bloke on Zoom.
Yeah, exactly. In fact, I was running a presentation a few days ago, and normally I always include a caveat that this is not financial advice, it's not taxation advice, it's not legal advice, and they explicitly asked me to talk about the impact of COVID-19 and what mitigation measures technology are using. So I had to include as well, and this is also not medical advice.
Yes,
So
I'm not a
and it's,
doctor
yep,
or a lawyer.
exactly. Yep. uh, so interesting, but yeah, it is fascinating to see where the market is going to go and what is going to be the driver, and whether it will be simply more people coming into the market because they realize that the one thing that surprisingly people still don't talk about crypto's main benefit as much as they should, which is censorship resistance. It's the fact that you can keep using it irrespective of whether you're allowed to or not, and
Mhm.
the fact that you can't have it suddenly confiscated in some way. So I was trying to remember, I was reading of another government the other day that are beginning to struggle, and there's talk about them imposing limit. In fact, that was it, Lebanon.
Lebanon, definitely.
I think it was was it in the Time? Oh, sorry, no, it was actually Private Eye, which I know is one of the lesser known financial magazines. But it talks about how it is in Lebanon at the moment. You can only withdraw, I think it's something like $200 per week from your bank account, or the
Yes.
equivalent of that. So that is incredible. What right has that government or that bank got to say, well, yeah, it's your money, but we're only going to let you have a little bit of it each week? That's just, which I think was one
Yep.
of the arguments Tony Vase was using the other week on a show I was watching as well.
Very much. Cyprus, 2013. The ECB said that they had to bail in the banks and save them, so everyone's bank balance got a 20% haircut. You've had, pension providers and pension companies taking kind of bigger chunks out of your pension, and because it's tied to the stock market and these boom and bust cycles, those people just about to go into their pension have found that that it's not as high as they expected.
Mm.
You had the Germans nick all the gold, after World War II, and even earlier in America. I seem to remember that back in the late 1930s, after the Depression, they asked, or was it before the Depression, or anyway, around about then, they asked everybody to bring in their gold, and they would give a certain amount, and then they said, right, the gold's not, it's not backed. No, well, anyway, they asked for the gold from people for a set amount, and then they priced the gold much higher because they saw the demand for it. And so, they've taken money out of individual pockets that way. And then you have all the kind of taxes that the poor have to spend, and you have all the money printing at the top that's going into the banks and propping up failed companies. It's a ridiculous system. And the sooner we get to a fairer system that's not controlled by powerful people and is not centrally controlled, the better for everyone, I think.
And that's where it's going to be particularly interesting this year with the impact of the virus on the economy, on businesses, and on individuals, as to if we end up with a major depression, if we end up with interest rates going negative, we end up with companies going bust, unemployment. People are going to want to have access to what they see as their money, which means you carry the risk of a run on the banks. Which again, the likes of the Bank of England, they do their sensitivity checking, their stress testing to make sure that banks can handle a large number of withdrawals in there. But I would imagine that most bank stress testing is based on the individual bank's balance sheet and not a systemic global collapse in some way. So, you know, Barclays have probably done stress testing of a run on their bank in isolation, but they've not considered it if HSBC and Bank of Scotland all that have the same at the same time, and it happens internationally. So we may suddenly have one of those situations where everyone's knocking on the door of the bank to withdraw their money, and the banks just can't deal with it. So
Yeah, it could be a kind of cascading kind of dominoes where, as we saw in the 2008 financial crisis, especially in the US, if Freddie Mac and Fannie Mae, who are the majority owners of all the mortgage-backed securities, had gone down, you know, it would have wrecked the whole kind of financial system. So they had to be propped up.
well, I was going to say that's where it's going to be interesting again. If you look at capitalization of banks and their balance sheets and their loan book and the reserves and the mortgage-backed securities, as you say, then a lot of the mortgages are going to be backed against property, and entirely understandable. Has anyone factored in yet what happens if the property market drops by, you know, a horrific amount like 30 to 50%, which again means you're going to have a load of mortgage defaults. And this is a bizarre thing because it seems as though property prices are about to collapse, but we're also going to have very low interest rates, and we're also going to have hyperinflation. And I don't quite get how you can have negative interest rates and hyperinflation and asset prices all collapsing. It just doesn't. I need to brush off my economics textbooks to figure out how that works because it doesn't kind of stack together.
Yeah, I'll have to kind of brush off some of my economic textbooks, but we first go through a period of deflation where everybody's running to the US dollar because a lot of assets are priced in the US dollar, and so those get kind of deflated in a way. Asset prices get deflated. Everyone rushes to the dollar, and then everyone realizes there's so many US dollars out there. You know, so then we get into a period of hyperinflation, and that kind of takes the rug out underneath assets. So it's and negative interest rates. Well, you know, it's an experiment. We don't know what's going to happen, and you know, whilst some of the Scandinavian countries have negative interest rates, it's actually tied more to their bond market, and it isn't in other countries, so they can kind of get away with it at the moment. But negative interest rates in other countries, because it's not tied to the bond market, it's going to absolutely wipe the bond market out, because you're not going to get yield or long-term bonds from the government anymore, and so you're going to have a rash of selling. Nobody knows the price of them, and that is a systemic risk. That is the systemic risk in the heart of the financial system. So I don't know what to say. Watch this space, sit down, protect yourself with various different assets, diversify. Don't buy too many of the rubbish shit coins in crypto. The ones that you know that will be around for a long period of time, have a decent roadmap, team, decentralized, adoption rates, you know, a good white paper, you know, do fundamental research, cover yourself, and let's see where this economy is going to go, because it's going to get ugly.
And that's where I'm trying to take an increasing interest in the DeFi world, because that seems to be the next big thing of real growth. But again, DeFi, the definition of that seems to be blurring in much the same way that the definition of cloud computing blurred and blockchain blurred and everything. It's kind of quite funny. I had a few conversations with a couple of people who were asking how they can do mark-to-market valuations of their DeFi holdings. And I said, well, hang on, as soon as you're trying to do a mark to fiat market price, you've lost the point of being in the DeFi Ethereum world, because you should be pricing it in ETH, not in US dollars. And they're going, oh, no, I still want to know what my US dollar valuation of this DeFi investment is and all this kind of thing. So you've not understood what DeFi is. So, well, have you been watching it with the likes of MakerDAO and Nexus Mutual and that kind of thing of late?
Brilliant. Yeah. We've been doing a bit of research on the DeFi space. it is fascinating, and I think probably the best way to explain the DeFi space is basically it's where everybody can use various different financial instruments in a part of the industry that doesn't have KYC and AML. You know, it's not really DeFi if you go through KYC and AML. You know your customer, anti-money laundering, which is the standard for the financial industry.
But in effect, you can have KYC and AML as long as it's not done by a single party. So this is, again, a conversation I had with a big consultancy a while ago about, could you actually have a series of effectively notaries who provide KYC and AML services, and so an individual is KYC approved, not by a single body, but by any number of notaries, and therefore you can trade as a KYC accredited type thing. The challenge is
someone has to manage those notaries, and the people managing those notaries will put in the policies in place to know exactly where you're going in the DeFi space. It doesn't make sense.
But this
especially
is
when you've got especially when you've got kind of smart contracts that can open up a transaction, get a massive flash loan, wrap it in other cryptocurrencies, send it to a DeFi platform, short it in one market, long it in another market, bring it all together, unwrap it, pay the transaction back before the transaction closes. That is possible in the DeFi space. How on earth are you going to do KYC and AML on kind of, how it hops globally from all of these different kind of financial Lego pieces? It's just crazy. You're not going to be able to do it, especially in one transaction.
But this is something that, if it's simplified KYC, and this is one of the problems that, KYC and AML in particular, it's not that you are KYC approved, it's that you are KYC approved for this type of transaction, for this type of organization, for this kind of trade in some way. And people don't actually realize it's not like a tick box, it's either yes or no. It's a lot more complex than that. But if you could have a simplified, you are a verified, authorized, approved user, then it's really easy. When your smart contracts execute to do all this stuff, they just check the is approved flag, and it's either a 1 or a 0. So it doesn't add any great overhead, and that can be maintained by other notaries who could do that in some way.
Yeah, but that's just putting extra hurdles in front of registration and people. And at the moment, you can use these services without KYC and AML. So why would I even bother?
Why you would bother is for the same reason that Amazon and eBay cracked a major technology problem a long time ago, which is about trust. So when you look at Amazon and eBay, we all use it day in, day out now. We don't think twice about doing a transaction on there as to whether there's going to be a problem, because we now trust their system. We know that they've either got a compensation scheme that will repay us, or the buyer or seller has got 5 stars and that's good enough for me, blah, blah, blah type thing. And that's where a simplified KYC thing to say this is a trusted participant comes into play. So you either put an insurance layer on top of the transactions, which means individuals can participate in the DeFi market and they can trust the system to make sure they don't lose anything, or you put something into place to say that this is an accredited, trusted user in some way.
Yeah, I think you're talking about how some of the traditional businesses can get into this space, but there are businesses already in this space that don't have that setup and don't need that setup to run. And so whilst it could be easier for those companies to have that type of policy and simplified KYC to get into the space, other companies are just getting into this space without the need for that. And also it creates a bottleneck because you've got to go through that process. Well, what we're seeing in the industry is that even banks with their reconciliation are thinking, hang on a sec, reconciliation traditionally is taking days, it's costing me money. Why can't I just send a massive packet of data to the DeFi space? It's going to be so much more efficient then following the traditional policy and even a simplified KYC AML process, it's going to be just bang, done. And the DeFi space is going to get far, far more efficient over time and far more trusted over time, the more it's used and the more funds are locked up and the liquidity is there. And so soon, traditional banks are going to go, well, my competitor is actually making millions by not paying intermediaries and this basic KYC AML process and just shoving it to DeFi. So the market is going to come to DeFi.
Do you think that's going to happen? Because as soon as you do that, where you've got an on-ramp and off-ramp between fiat and DeFi, it's no longer DeFi. You know, it suddenly becomes just another point on your centralized network. In effect, it's just we can do the KYC route, or we can do the DeFi route, and we'll try and shove the DeFi route because it's faster, quicker, cheaper. The problem is for traditional regulated organizations is they don't have the luxury of being able to say, well, this type of transaction will route through our normal KYC, CTF, AML compliance process, and this type of transaction, well, we know that's going to be a pain, so we'll send it through a DeFi space, because they'll get prosecuted either way. Yeah, and this is the whole thing, that a lot of financial institutions, certainly regulated ones, they won't play with the crypto market in general at the moment, simply for fear of them being involved in a transaction that is later proved to have been irregular in some way, for which there is now a comprehensive and immutable audit trail for it.
Yeah, and we're seeing some of those type of services. So, you know, full disclosure, I do use these services, but the likes of Celsius, BlockFi, and Crypto.com, they have one leg in the traditional finance space and go through KYC AML for knowing their customers, but part of it is then kind of sharing the collateral out in a lending platform in the DeFi space to actually make a return. And so they've got one leg in each area. But if you're a perfect DeFi startup, you have no regulation and you don't particularly even want to touch the traditional financial industry. You know, you want to play in your own space. And this is where I want to say, you know, Cuberoot64, my company, we're actually starting to look at developers who understand the DeFi space and can construct wallets and pull some of this together, but play in the DeFi space and not in the traditional financial space. Mm-hmm. So we, you know, in our little sandpit, and see what we can do. So there's a lot of research going on in the background, but if anyone is interested, Cuberoot64 might be hiring for these type of people to have a look, and quants to have a look at some of the data and kind of constructing all of this.
So you made an interesting point that ties in with a different conversation I've had about a frustration in the crypto space, that we have this thing called a wheel, and people say, well, why don't we invent this new circular thing type thing? And this often happens. That's why the number of conversations I've had with people who said, oh yeah, we're going to build our own blockchain. It's like, well, can't you just go and take one, you know, off the shelf like Ethereum or Dash or whatever? Oh, no, we have to go and build our own. So everyone likes to invent their own wheel. Why do you feel there's a need to build your own wallet as opposed to taking something, you know, like Pillar have got their wallet, which is now live, and there's a few others out there. Is there any particular reason why you think you need to build your own?
Yeah, there's a couple of open source wallets we're looking at. If we do trust a non-open source wallet, then we've also got to trust, you know, the development behind that. And there are some elements of DeFi that I can see coming that are going to be extremely interesting and open up new innovative business areas that maybe haven't been tried before. You know, this flash loans and wrapping Bitcoin and wrapping Ether up and sending it and shorting it on various different decentralized exchanges is very, very new. You know, it's only in the last couple of months that this has happened, and we're starting to test those. But once you get all of these Lego bricks of different protocols that can offer different models, you can start to kind of formulate some innovative, you know, business ways in which you can offer interest in kind of micro payment interest on a second by second basis. So let's say a retailer accepts cryptocurrency, as soon as that hits their account, they're earning interest on it. So they don't kind of have all of the money accepted throughout the day and then go to the bank and then deposit that. They're actually earning interest from the first second. And there's all of these fantastic things that will come out. And I think being in control of some of the kind of wallet design and what you can and can't do is going to allow us to experiment.
I'd say that's where it's going to be interesting to see what impact that has on things like counterparty risk. Because if you're able to suddenly transact in some way and you're allowed to able to do like a flash loan, then it means things like counterparty risk should disappear. And it also means things like, systemic risk still going to exist, but it goes back to this conversation earlier on about negative interest rates, about what do you do with when you're calculating an interest rate. Part of the calculation is usually the zero risk rate of return is where you start. And one of the arguments I've had with someone, I think it was an economist, is that there's no such thing as zero risk anymore. Everything involves some sort of risk at some level.
I totally disagree, because you have these flash loans, wrap it up in a smart contract, and the smart contract actually says that it goes through all of these systems and pays back the amount. And if it fails at any point in time, that transaction just doesn't happen. So it's actually a risk-free way of possibly investing in the future. Likewise with something called ETH-Lend.
Yep.
ETH-Lend allows everyone to kind of put their money into a pot, and one person gets the interest over a time frame. And then after that interest is paid out to that one lucky user, everybody gets their funds back. That you could call that a risk-free rate of return. Yes, it's a gamble as to whether you're going to get the interest. So it's a slight speculation, but you actually get your capital back. Yeah. So we're now starting to enter into an economy where you can have risk-free return.
But that's another good example, as you mentioned earlier on, where IOTA went offline for a while. What happens if Ethereum went offline? Say there was a fundamental bug or whatever, or another mega hack, and they said, look, we just need to take everything offline for a while to sort this out, which means all of a sudden it's not possible to cash in or cash out, which is going to cause all sorts of problems. And then you've got the things of, has everybody designed their smart contracts in a way that they can be effectively be suspended or not? Because I've been looking at some of the testing that some people have been doing on their smart contracts, and it's questionable at best and dreadful at worst. So they won't even be comprehending more extreme things like system outages now. That they won't even be considering that for the testing. So that's where I think there is again a systematic risk that needs to be factored in some way, as small as it might be.
Yeah, I mean, when we started to get these wonderful financial instruments in the traditional industry, we had the same problems.
Yep.
They were clunky. Different businesses had different methods and different processes and policies, and we had all these financial instruments in the past, and we had to eventually trust them and break them to an extent to make sure they're resilient. The same is going to happen in the DeFi space. And for Ethereum, yes, I don't have any money in the DeFi space at the moment because of this fact. Smart contracts could break, and let's give it a bit of a roadway to prove itself first.
Yeah, and it goes back again to what I've been saying, that the crypto world is effectively mirroring the traditional financial services world, and it's experiencing the same problems and the same pains. And this is where there are more and more pseudo financial instruments coming into being, where you're getting things like custodial services, insurance, all this kind of thing, which is replicating what goes on in the real world. So definitely, I see that happening. Right, for some reason my screen is beginning to go dark, so it's probably trying to tell me it's time to finish this call now, which is unusual.
It's been a good chat, Gary. Thanks.
Yeah, and I have got my Zoom upgrade now, so it means we can last longer than 30 minutes, which is great. But yeah, it's been really good to chat, Anthony. Shame no one else joined us, but sometimes these one-on-ones are that allows us to explore things a little bit more in depth, I think, which is great. So we'll finish off for now. I'll leave as my usual thing of saying, now wash your hands and have a good day.
Okay, thanks, Gary. Cheers, mate.
Cheers. Bye now.
Bye bye.